Welcome back to Market Lens. I'm Daniel Reed. Today is May 7th, 2026, and we are witnessing a phenomenon I call the Janus face of the market. To the front, we see a world rushing toward a historic 14-point peace treaty. Behind the scenes, we see a U.S. Navy strike on an Iranian tanker and a $50 billion military AI merger that just changed the Nasdaq forever. How can the market be bullish when the guns are still firing? How can the Nikkei surge 6% while a naval blockade is being lethally enforced? Today, we are going deeper than the breaking news alerts. We are dissecting the 14-point Memorandum of Understanding, the logic behind negotiation by fire, and why the smart money is betting that the algorithmic battlefield is the most profitable trade of the decade. Let's get into the details. Let's start with the document that everyone is talking about, the 14-point Memorandum of Understanding. We've spent the last 12 hours cross-referencing our sources in Washington, Islamabad, and Tehran. While the White House hasn't released the full text, the structural pillars are now clear. This isn't a final treaty. It's a 30-day negotiation window designed to freeze the conflict before it goes global. The core points are transformative. First, an immediate ceasefire across all fronts, including the high-tension border in Lebanon. Second, the total lifting of transit restrictions in the Strait of Hormuz. This is the energy exit the market has been pricing in. Third, the release of billions in frozen Iranian assets in exchange for a 15 to 20-year nuclear moratorium. But the real intelligence is in point 7, the snap inspections. The U.S. is demanding UN access to every enrichment site within 24 hours of a request. This is the point where the negotiations usually fail. But look at the market reaction. The lack of a fear spike tells you that institutional investors believe Iran is finally desperate enough to say yes. Logically, if this 30-day window is signed, we aren't just looking at a rally. We are looking at a fundamental re-rating of global risk. We are moving from a conflict discount to a stability premium. This is the primary driver behind today's futures strength. Now, let's address the paradox. If we are so close to a deal, why did the U.S. Navy fire on an Iranian tanker just 4 hours ago? Mainstream analysts are calling this an accident or a provocation. At Market Lens, we see it as a tactical enforcer. In a Daniel Reed logic model, you don't offer a 14-point exit ramp unless you first walled off every other exit. The strike on the tanker was a signal to the hardliners in Tehran. The 14 points are not a suggestion. They are the only remaining path to survival. The blockade remains active until the ink is dry. This is negotiation by fire, and remarkably, the market loved it. Why? Because it provided certainty. Investors hate a maybe. By firing on the tanker, the U.S. demonstrated that it is not negotiating from a position of weakness or hesitation. It is enforcing a baseline. The VIX, the market's fear gauge, actually drifted lower after the news of the strike. The smart money knows that a strong negotiator is more likely to close a deal than a weak one. While the world was watching the Persian Gulf, the real, long-term story was breaking in a series of boardrooms in Arlington and Palo Alto. The U.S. War Department just finalized a landmark integration with 7 tech giants, including NVIDIA, OpenAI, and Google. This is the birth of the algorithmic battlefield. We are talking about the immediate deployment of large language models and predictive AI directly onto classified military networks. This is a $50 billion pivot that fundamentally changes how we value big tech. For the last year, the AI trade has been about consumer productivity and enterprise efficiency. Today, it became a core pillar of national security. Think about the moat this creates. When NVIDIA chips and OpenAI models are baked into the Pentagon's tactical decision-making loops, they become too big to fail and too integrated to replace. This creates a high-margin, multi-year, government-backed revenue stream that is completely decoupled from the consumer economy. This is why the Nasdaq is showing such resilience. We are seeing a rotation out of discretionary AI and into defense AI. The algorithmic frontline is now the safest play in tech. Let's pivot to the global stage. Watch the technicals here. The Nikkei has broken through its 200-day moving average on record volume. This is a classic institutional flush. The money is leaving safe haven bonds and piling into Asian growth. And look at crude oil. Brent is now trading comfortably below the $100 psychological level. This is the deflationary gift that the Federal Reserve has been waiting for. If energy stays at these levels, the Fed has a clear runway to maintain its current stance or even signal a pivot later this year. The inflation monster just lost its primary fuel source. Finally, let's look at what the earnings are telling us about the 2026 consumer. DoorDash is up double digits today. Despite the weather-driven revenue miss we identified yesterday, the $31 billion in gross order value was a mic-drop moment for the logistics sector. It proved that the consumer is prioritizing efficiency and digital-first services, even in a high-rate environment. On the other side of the ledger, we have Whirlpool. They reported a surprise loss, and the stock is being liquidated. The logic here is fascinating. The consumer is spending on delivery and experiences, but pulling back on big-ticket hard goods. We are seeing a digital-first recession in physical goods, while the service layer of the economy remains in a boom. One hidden detail: Liberty Media reported a 53% surge in F1 revenue. Think about that. They had to cancel 2 races in the Middle East due to geopolitical tension, and they still grew by 50%. This is geopolitical resilience. So, where's the market headed for the rest of the day and into the weekend? It tells you that the top-tier global brands have learned how to manage risk and maintain growth even when the map is on fire. We have identified 3 logical scenarios. Scenario A, the weekend signing, the bull case. If Iran formally accepts the 14-point MOU before the close tomorrow, expect a short squeeze of historic proportions. We could see the S&P 500 challenge the 5,600 level as the geopolitical risk premium is completely wiped out. Capital will rotate aggressively out of gold and defense stocks and into high-beta tech and consumer discretionary. Scenario B, the tactical stalemate, the base case. Iran continues to review the proposal while the U.S. continues to enforce the blockade. In this scenario, we expect a grind higher. The market will trade on the technical strength of the Nikkei and the earnings beats from Dash and DIS. We see the S&P 500 holding the 5,500 level as a new base. Scenario C, the breakdown, the bear case. Tehran rejects the SNAP inspections and the U.S. ramps up military strikes. This would trigger an immediate risk-off move. Oil would gap back above $110, and we would likely see a 3 to 5% correction in equities within 24 hours. However, looking at the institutional flows today, Scenario B is currently the most probable. The smart money is buying the dip and holding for the deal. The 2026 market is not for the faint of heart. It is a machine that processes bullets and balance sheets at the same time. But if you look at the data, the AI Pentagon nexus, the $100 oil break, and the 14-point framework, the logic points toward resilience. We are seeing a world that is learning to price in conflict as a negotiation tactic rather than an existential threat. Stay sharp. Watch the oil charts and the 10-year yield. If oil stays below $100, the bulls have the ball. I'm Daniel Reed. This has been Market Lens. Stay logical and see you next time for the upcoming analysis on the AI defense contractors and what they mean for your long-term portfolio.